So yeah, let's look at this TCS thing once again. So what we were doing when pyramiding, the mistake that you guys made was, so what we wanted to do was we wanted to find out, of course, with respect to pyramiding, because you're putting on a new position. So we run through the entire gamut of decision problems once again. We went through all of that. Everything is pretty much clear. But the only thing that was not clear was how many units to buy, right? Okay. So that we decided by a certain method. Okay. And for that calculation, and we knew that the stop would be here. Okay. So what we decided, the problem that was, you guys gave me the wrong level. I didn't check it. Okay. Now this. So I just want to run through the reason once again. This is your calc file. Most of our calcs we have done here, so maybe I can rename this file as calc IPM 19. There will be only one IPM in 19. Yeah, so calc IPM 19. So the mistake, I've corrected that mistake. If you remember yesterday, we got a figure around 6,500 something shares, right? So that figure was wrong because the one of the inputs in the formula that you gave me, this one was wrong. This was some other figure that you gave me. This should have been 2032, which is actually our stop here. Okay, I think. Yeah, you can still see that 203240. So we've left the 40 out. So this should have been, you guys gave me a different number. Okay.
So we actually calculated for the short-term file previous year.
No. That's why I want to run through I just want to make sure that everybody has understood correctly, because sometimes you may understand, but you may not. You may think you understand, but you have not understood. Okay. You are going to be tested on all these concepts in the exam, so you better make sure that your concepts are clear. And mugging up will not help you. If your concepts are not clear, you will get a case kind of problem. So, or you will get small problems, which are all basically application oriented. So if your concepts are not clear, then you won't be able to answer any of the questions. Okay. So anyway, so what happened was, okay, let's be clear about what we were trying to do here. Okay. So when we went long here for 1,000 shares, later on we said that 1,000 was just actually not one lot, but it was conceptually two lots. It was 500 shares for the long-term position, for the long-term system. Okay, which had and both of them, so 500 shares for the long-term system and 500 shares for the short-term system. Okay, and then the long-term system, the stop remained over here, but then for the short-term position, for the short-term system trade, we moved the stop all the way up to here. Okay, because we saw this short-term trend developing with highs and lows that were clearly visible. Okay, so the point was that when we were trying to pyramid over here, the point is you have to ask yourself, basically, when you're pyramiding, that on the original, basically with the idea of pyramiding is that, we should mention this here, okay, because we got into all kinds of other discussions also, because of the question that Tarun asked, which is good. You should always ask any question that comes up. Okay. The point here in pyramiding is that pyramiding should be done without increasing the total risk for that system. There is the writing is not very elegant, but I'll explain to you what it is, but I think you'll understand later anyway. And this is all being littered in your outline sheet, so all this information is there. You don't have to write it down word for word. Okay. So without increasing the total risk for that system, that is the total risk allowable per trade. Okay. So initially when I put on that trade, I was just trying to initially quickly execute a buy, so I didn't think about all these things. But the way it should have been done actually, so you understand what the proper procedure is. If at one point of time you're putting in a trade for two different systems, okay? So each system will have a risk capital allocation. Okay, so each system, let's say you have $1 million allocated to each system. Okay, so that's your risk capital. And the rule I've given you is that you can only risk 1% of $1 million of your risk capital per trade. Okay, later on we'll figure out how we can have maybe a number different from 1%. For the moment we are just working with 1% as a shortcut solution. Okay, it has to be a low number. So then you take 1% of 1 million, and that is how the position sizing should have been decided. That you would have looked at the entry price, that 2101. You would have looked at the exit price 2032. Okay, and then you would have seen the loss per share projected. Then that number of shares that you would have bought. Okay, we can do that exercise once again. Okay, so if we have just add one more zero here. Okay. Right. Okay, so we have $1 million of risk capital. You have 1% of $1 million. Okay, so you know that you can risk $10,000 per trade. Now here, so the way we should have done it is that if you have $10,000 per trade and your entry price is, in this case, what, 21. Let's just use round numbers. We'll use 2101 as your entry price, and your exit price is say 2032. That's what we were doing. When we were looking at this, we were trying to enter at 2101 roughly, okay, and we were using a 2032 exit price. Okay, are you following? Because so we don't know all this stuff here, but the market is here, this is the current price, and that's when we were entering. So the way you should have thought about it is that you have $1 million each for the long-term system and the short-term system in terms of allocation of risk capital. So 1% of $1 million is your $10,000. Okay, then all right, so you can risk $10,000 per trade. Your projected entry is 2101, exit is 2032. So projected loss per share is, I'm sure the formula is correct, is 69. We'll just say, we'll assume dollars and rupees are the same, just for the sake of this calculation. Okay, so 29 let's say just call it $29. Okay, so we're losing $29 per share. We have added some brokerage consideration also. Okay, and then what we have is the number of shares that we can enter, that is arrived at by taking, okay, you should take the total cost per share is going to be round term brokerage is taken as per share. Okay, supposing you have $1 per share. So what you're going to lose per share is the $69 plus the $1. Okay, so that's your divisor here, and then you have this is the amount of total amount that you can lose. So therefore you figure out the number. Is everyone clear about this? This much algebra, everyone is clear? Saloni, you're clear? Okay, because if I take this numerator and I multiply into the number of shares, I will get the total loss, right? So you have the numerator, and then you have, so what we are saying is number of shares, maximum number of shares is equal to maximum loss divided by loss per share. Because if you take this so if you cross multiply here, if you take the number of loss per share into the number of shares, you will get the total loss, right? So that's why the number of shares is divided. I'm just making sure, this is like very baby algebra, but I'm just making sure that everybody's clear about that, because many of you have a fear of maths and all that. Is everyone clear about this? Now we've already done baby algebra, so nobody should have any doubt why this formula is like this. Is everyone clear? Okay, so therefore we have figured out that we can do 142 shares. Okay, this seems a little bit okay, 70, 10,000, something. Okay, we will do. Is there something wrong here? One second. It seems a little low. Okay, fine, no problem. I just feel like maybe my sense of numbers is not correct. Okay, So I just want to do, I don't know, somehow I can't believe it. Anyway, it seems a little low to me. Anyway, never mind. Okay, so 143 shares, is everyone clear? Okay, so so obviously my visual sense of maths is not good. So 143 shares. So this is how I should have decided that I will buy 143 shares for each system. This is clear? This is how I should have decided. So that 500, that's because I wanted to just quickly buy some shares in a hurry just to show you the execution of the trade. So that should not have been 500, that should have been 143. Actually 142, because I've rounded it to 143. So you should have rounded down actually. Okay. So is everyone clear now? Yes. So we should have bought that much now. So now when we are pyramiding, what we are saying is that in pyramid, so what is the rule that you followed? We are pyramiding for the short-term system. So therefore we are going to focus on the maximum loss on the short-term system. Okay. So what we are going to say in the case of pyramiding is that whatever maximum loss maximum loss figure per trade I was operating with in the short-term system initially, that does not change when you start pyramiding. What I mean to say is that when you decided to buy some shares for the short-term system, and when you calculated how many shares that would be, okay, this 10,000 figure that you were using, okay, for the short-term system, this will still not change. Which means that at a point of time, you can't have more than 10,000 exposed, okay, for your short-term system. Okay, per trade you can't have more than 10,000 exposed for the short-term system. So now what you see is that on this, so this is the limit that you have to follow, because this is like a new trade. This is like a new trade, so it has to follow the rules of the system, which means you can't exceed the 10,000 limit. Okay, so in this case what is happening is, because is everyone following so far? Yes. Okay, so even for the pyramiding, that's all I'm trying to ensure, that just because you're pyramiding doesn't mean that everything goes haywire, that you start going galloping like a horse. So you have to be controlled even when you're pyramiding. Okay, so the maximum risk considerations that apply to a new trade will apply to a pyramiding trade also. Okay, so there could be two kinds of situations. There could be a situation that in this situation you see that on the original lot, okay, on the original lot you went long at 2101, and if you're stopping over here, you're going to make a profit. There's no loss involved. Yeah, this is clear. Okay, so therefore you can take the entire 10,000 allocation that is there for a new trade and use that for the pyramiding transaction. Are you following? Because on the original lot there's not going to be any loss. Okay, so you can take the entire 10,000 allocation for the pyramiding transaction, which means when you're deciding how many shares you want to buy when you're pyramiding, okay, let's say that you were pyramiding at this point, let's say we'll just make it a little more realistic. Let's say that you were trying to buy at 2230 and your stop was at 2207. Okay, so when you're pyramiding, you have to again do this new calculation that you're entering at 2230 and this is your 2207. Okay, now you can buy 417 shares. Okay, is everyone clear? So actually we should, for sake of good practice, which means we can only buy 416 shares. Is everyone clear about this now? Okay, so that's what we're trying to say, that the rules that apply to maximum risk per trade in an initial position, okay, when you're starting out the position, and on that same kind of view, on that same kind of you're running with the same view here, adding two positions. Okay, so initially you had some 143 shares, now you are adding to you're going to add another 400 shares, and if you're lucky and the trend keeps going higher and higher, you will keep on adding positions. So eventually you may end up with many lots and a total position which is much higher. But at no point of time when you're adding positions can you violate this rule, that maximum risk per trade should remain as 10,000 max. Okay, is that clear? So now you have, that's why, so in this case you saw that on the original lot there's no risk. Okay, there's actually a profit, so you can keep the entire 10,000 for the new pyramiding position. Is this clear? Now it might have been that, I'm just giving a kind of like a by force example, which is going to look very weird. But assuming that you had initially bought something here, okay, the short-term position you had bought here, okay. the first lot which I'm talking about being bought here, let's say it was bought at a much higher level. Okay, let's say that we have these two figures, right? Let's say I want to just show you a kind of like a Biforce example. So, all right, what I'm trying to say is that let's assume that the original lot that was bought here, that 143 share, 146 or whatever it was, okay, that was bought over here, was not bought over here, but it was bought somewhere here, let's say. It had been bought somewhere here. Are you following? Okay. In that case, you're looking at 2222. Okay. So if you go back to this, if you had an original lot that was bought at 2222, and it's going to get stopped out at 2207, because what you have done is, after you bought it here, then you saw the market drop so much and then it rose, but because you saw these high-low patterns, you raised the stop on the short-term position to here, 2207. Are you following what we are saying? That it was bought, the original lot. Now we are assuming, we are doing a hypothetical already. Okay, so we're saying that, assume that it wasn't bought here. What if it had been bought over here at a price of 2222? The original, the first lot for the short-term system. Are you following? Is everyone on board? Okay. In that case, what is happening when a 2222 position gets stopped at 2207? Is that a loss or a profit? Loss, because it's a long position. Okay. So then now you have to basically, what you have to see is, what is the loss on this 2222 minus this? The per share loss is 15. Okay. So, and the number of shares you bought was, I think, 143. I think something like that we bought, 143 or something. Okay, which I was not, it didn't seem like a big enough number to me. Okay, so which means how much are you going to do? You bought here, you bought 143 odd shares at 2222. Now you, after all this drama which came down, went up, you move the stop here. So that 2222 is now going to get stopped at 2207, which means it's going to lose $15 per share. Is this clear? Yes. I'm just mixing dollars and rupees. Alright. Okay. Is everyone so on board so far? Okay. Which means how much am I going to lose on my 143 shares? I'm going to lose 143 into 15. Here we have not added the brokerage, but let's just assume that it's not there. We can be in real life, you would add it. Okay. So I'm going to lose 2145. Okay. All right. So now the question is, when you are now, is everyone on board so far? So on the first lot, even on this current stop, trailing stop, assume all this stuff has not happened. Okay, we are somewhere here. Okay. So on this first lot, we are going to lose $2145. Okay. But we still want to pyramid because it's going up. Re-established. Okay, when we are going, it's still going up, so we want to now, after all this drama, now the market seems to be moving in our favor, so we still want to pyramid. Okay, but we are losing 2145 on the initial lot. Okay, so when I'm adding a second lot, what should this number be here? Risk per trade number that I want to, when I'm planning. Now again, I'm back to the original problem of what is the position size on the second lot. On the first pyramiding lot, what is the position size going to be? Okay, how many shares extra can I buy? What in arriving at that calculation, are you following so far? You're with me? Okay. What should be the risk per trade number that I use? Is my question clear? In this system, in this trading, the short-term trading system, my risk management budgeting, my risk planning has come up with an output that I should not have more than $10,000 at risk per trade. Okay, so now in this case I'm trying to pyramid, and when I'm trying to calculate how many, I already have a position at 2222 for 143 shares. Okay, now I'm trying to add some more positions as the market is declining to what seems to be, and I feel that this will not break. Okay, this is only for the purposes of our discussion. Okay, so so therefore when I'm looking at the market somewhere here, okay, and I'm trying to add some more, add some more shares. Okay, pyramid my long position, and I want to calculate how many more shares can I afford to buy. This is clear? This is the decision problem. Then when I'm trying to solve this decision problem, I'm going to use the same framework. Okay, But in using that framework, what should be my input here for calculating the number of shares that I want to buy, that I can afford to buy on the pyramiding leg, on the second lot?
10,000 minus 2145.
Yeah, so it should be 10,000 minus 2145. Is everyone clear? Okay, that's all I'm trying to say. Again, pretty simple. So which means that will ensure that on a total basis, you will not lose more than 10,000 minus 214. You will not lose more than 10,000. This is clear? So you maintain your, that per essentially, like, it's even not per trade, it's like per stock against a particular stock. So the real meaning of what we really mean is per unique stop. Okay, I'm not going to call it stop loss because in some cases it will. Total risk allowable per trade according to the system. Okay. So the risk for that system, okay, the total risk allowable per trade and actually per unique stop. Are you able to follow? When we give this guideline of 10,000 risk per trade, actually it is a risk per stop. Okay. Really what it is risk per, I can just copy it from, here stop means this stop order, okay. Because the stop essentially defines a view on a particular time frame. Are you following what I'm saying? It's not so much risk per trade because here actually typically against this stop you would have two trades now, because you had that initial part which you bought at 143 shares you bought, that is one trade or one lot, okay. Now you're adding a second lot, okay, so technically you could say this is a second trade, okay. But what we are really saying when we say maximum risk per trade, what we really mean is maximum risk per unique stop, because the whole trading system is anchored on stops, because it's a stop that helps you to control the risk. So you can think of everything is in terms of per unique stop, because the stop is also intimately connected to the view. Can you understand that? That everything, the stop is intimately connected to the view. Because what is the view here? The view here is the reason we were thinking of pyramiding. Of course, I did tell you that I thought this was going to break yesterday. But now for the sake of our example, we'll calculate something. We'll just assume that this stuff hasn't happened. When you are thinking of buying here, what are you actually saying? If you are thinking of buying more, that means you believe the uptrend is still going to continue. Okay? So therefore, this becomes, the stop is intimately connected to the view, because the stop is at a place where if the market goes beyond that, then your view is invalidated, because your series of higher lows, higher highs, the pattern of higher lows is broken, so the trend becomes neutralized, so your view is proven wrong. So you can see how the stop is intimately connected to the view. The stop basically derives from the view once you have fixed the pattern size. What pattern size because when you're looking at this pattern size, when you're looking at this kind of pattern size, you're obviously not looking at these big size pattern swings here that are happening. That's a different degree of movement. Are you able to follow? This is like these movements. If you just look at these big swings like this is a bigger time frame. This is a further zoomed out view. Whereas this one is a very zoomed in view. If you're looking at this degree of swing, this is a much more zoomed in view. So you have to be clear about the time frame. But once you zero in on a time frame and you form a view, the view is intimately anchored in the stop. The view is totally anchored in the stop, because once the stop goes, then the view goes, right? And if the view goes, then the position should also go. So the position is based on the view, so if the view is destroyed, the assumption underpinning the view is destroyed, then the position should also go. That's why you have the stop over there, okay? So you can you see the logic of all this? Are you able to follow that there is a logic to the system? Ritesh is not convinced. Are you able to follow that can you see that there's some logic to this kind of technical trading, even though it seems like very simple? But given the fact that you will, no matter where you look and whatever time frame you look, you will always see these high-low patterns. The only thing you can't be sure about is when this is going to break. That you'll never know. And no matter what you do, no matter what kind of model you come up with, you will never really know. If you think you know because of some model, then you're a fool. Okay, so you should always be clear that you will never know. But that's okay. You don't have to know in order to make money. All you need to do is basically be consistent and use very tight stops, okay, so that per trade you're not losing a lot of money, and then use very wide take profit, so that reward to risk ratio has to be very high. You can see here basically already you can see that on this, of course we didn't have a big move here on the short term patterns, okay, we could have had a much bigger move. In this case you would have never taken profit, you would have just kept on moving the stop higher, okay, and then you could capture a lot more profit. So if you capture huge profits when you have a winning trade and you have very small losses, okay, you don't really need to know whether it's going to work or not. You need to have some kind of, okay, you can have some kind of maybe 50-55% accuracy. Okay, we'll see these calculations later on. Okay, how even a low accuracy rate, low hit rate, like you're right only about 55% of the time, and you can still make money if your reward to risk ratio is high. Okay, so we'll look at that. So you don't have to know. So this is a very simple system, but it's not simplistic. It's actually quite powerful. You have to basically use it in a very disciplined way. Okay, so that's all we're saying, that in the case of the risk per unit stop, so you have to understand this, that basically a view is defined anchored in the stop. Okay, so that when you have these risk limits, okay, these risk limits should apply for each system. Okay, these risk limits should apply per unique stop. Okay, so just like our long-term system also, we had $10,000, so we had 143 shares which are still running against the 140, with those 143 shares. Of course actually we bought 500 shares, but it should have been 143, and it should be running against this same stock, which you can still see that the system is still running this 2032 stock for the 500 shares. Are you following? Okay, so this thing is still here, the stop has not moved because we haven't made a new high. Okay, this high is not higher than this high. This is the highest high so far, but this high is not higher. So eventually, if we don't go below this and move around here somewhere, eventually if we do go higher, the moment we make a higher high than this one, this is the highest high so far, the moment we make a new high, okay, moment we post a new high, then we will be able to move, because if you look at the degree of this movement, on this chart, we can even see it in the 30-minute charts. The moment it makes a new high, we will be able to move the stop from here to here, which is a little bit higher, not a lot, but logically it should be moved. Are you following the logic? Can everyone, is everyone following what I'm saying? The moment it makes a new high here, because in this big picture pattern I'm following these kind of big moves, okay, like this one, up, down, these big moves. I'm not interested in these small squiggly things for the big picture system. Okay, so I'm just watching this high, is it making a new high or not? Okay, so the moment it clears this high, I'll be able to move my stop from here to here. Okay, not much of movement, but you have to be consistent. So you have to be very careful about because emotionally you may not feel like doing all this. Emotionally you may already feel like moving a stop here, okay, because it has gone up so much, but technically you can't because it hasn't made a new high. All right, so therefore, because theoretically it is still possible, if you look at this, there's a fair bit of difference between these two. Theoretically it is still possible that you can have this stays below this high, then comes down, goes below this, but does not go below this. It's possible. Anything is possible. Okay, so therefore you should not move it here, because then if it does, see, suppose you you're in a moment of weakness, you want to do, I don't want, after going up so much, I don't want to lose so much money, let me just move it here. It's tempting. Okay, so you move it here. Now what happens? The market comes down and stops this one out, okay, goes below this, but doesn't go below this. So your original thesis, and then eventually breaks below this, but doesn't go below this, and eventually turns around and goes above this. So your original thesis is still valid. Your original assumption was what? When you were buying it here, your original assumption was basically that the market will go above this. The highest high that you have seen so far, the uptrend will continue. Okay, so which means a new high would have to be made. Okay, the market would have to go above the highest high so far. So your initial assumption when you were buying here for the long-term system was that this will go, the market will go eventually go above this, but it will not go below this. Are you following? Yes, Anju, you don't seem you're convinced. Okay. So now what has happened? Your assumption is actually still valid because it doesn't go below this. Eventually, it takes a long time, doesn't go below this, and eventually goes above that. So your assumption was valid. Okay. So you were right, but you've given up your position because you moved your stop over here. Are you following? Okay. So that's why. So just like the flip side of what we said earlier, the reason we said the stop is here is that if the assumption on which your view is based is invalidated, then the position based on that view should also be removed, cancelled out. Are you following? You have an assumption, you have an assumption underlying your view, and based on that view you take a position. Okay, so but if the market action proves that your assumption was wrong, okay, assumption underlying the view was wrong, that means the view was wrong, so therefore the position based on that view should be removed. Okay, that's why we put the stop there. So the flip side of that is that, but then the position based on the view should only be removed when the view is proved wrong, not otherwise. Are you following what I'm saying? By moving the stop from here to here too early, you would have created a situation where you would have given up your position would have been removed, but your view was never invalidated. Are you following what I'm saying? Okay, so that's why it's very important to be very rigid about this. Rajan, are you following the logic? Okay, so you have to be disciplined on both sides. So there should not be any, which is why you will find that when you read books on trading, okay, there's a good book I should mention. I'll give you a list of books. It's very important to read classic books. Okay, then I'll give you a whole list of books actually. So I'll just give you two books right now. One is right in the middle of it. It's basically, this is off topic. Okay. So let me just because it's very, I see, instead of wasting your time on doing all kinds of courses even outside the system, okay, because I don't know what the quality of those courses is. It's very important. You can still do that, provided your first priority should be your coursework. Then you should read classic books, okay. That is much more important than doing, all kinds of certificates here and there, because most of these certificates, the quality is not very good. So it's better if you read a classic book. You can even talk about it in your interview. That I've read The Intelligent Investor, I've read this book. So you can talk, and there's a lot of learning you can derive from reading classic book. That education is much more important. Okay, so be careful in your priorities. Okay, so the couple of books I would say, you can just Google for this on the internet. You will get it. Okay, you'll find a PDF available on the internet. Okay, Ben Graham. Okay, so this is actually Warren Buffett's favorite book. Okay. Then, so this is one book I'll tell you. I'll give you a proper list later on. And the other book that you should read, what was the book? Okay, this is the book I was talking about, Trading Psychology. Okay, so what's that book? Okay, so the author is Mark Douglas. Okay, so they're all being written in your notebook, so you have access to all this. Okay, so Mark Douglas, and okay, so the name of the book is The Disciplined Trader. Okay, so later on, that's why you see that so it's a very important book. You can see here, so I think even both of them, you'll get them on the internet. Okay, so this is a very important book for what I call FA. FA is fundamental analysis. Okay, so as a fundamental analyst, this is the first book you should read. Okay, and of course you've already done a lot of your ratio analysis. Your ratio analysis should be you should be very fluent. Okay, you should be able to do it with your one hand behind your back. Should be so fluent in ratio analysis. Okay, and then you keep following the business news, and you can see analysts talking about different ratios for companies, what's happening to their operating cash flow and things like that. Like just this morning I was listening to a report on Netflix. You have that Bloomberg technology report program which comes out. You should listen to it actually. Bloomberg Technology. It's a 45-minute program every day, 5 days a week. So the posting is a little bit delayed by 1 or 2 days, but you can still listen to it. So they were just talking about Netflix, and there's a new rival called Roku, which is a big streaming, is really doing very well. The share price is outperforming Netflix. So they were talking about Netflix. Even today, Netflix is not operating cash flow positive. Okay, so this is one of the things that people look at. So therefore, you should be very comfortable how to arrive at operating cash flow and things like that. These things should be second nature to you. So this is all in the realm of FA, and this is a very important book to read for FA. Okay, and this one of course is on trading psychology. Okay, which is a very important topic which is never addressed. No MBA course that I know of they address this aspect, but this is very important. After all, we are talking about the investment business. Okay, and trading means here I'm just using a short word. It covers everything. It covers all your investing, value investing. Okay, whatever else you want to talk about. It even covers corporate treasury risk management. Everything is covered. So pretty much like almost 70 to 80% of all the stuff that you do in a core finance role is covered by this concept of trading. Essentially, what it means is, I would say even higher than that. I would say almost 90-95%. Because even in a corporate finance role, you have to take a view on markets. So if you're if you have permission for an IPO, okay, now you see a lot of, because the US stock market's doing very well. Okay, so now there's this new company called, you must have seen the offices of WeWork. WeWork is actually a real estate company. It's a commercial real estate company, but they focus on all these new startups, technology startups. You give them workspaces. So WeWork is generating a lot of revenue, and now they've filed for an IPO. Okay, so you can see how, because the US stock market is doing so well, companies are coming out of the woodwork and trying to sell their shares. You had the IPO of Uber, okay, and you had the IPO of Lyft. Lyft is a local US competitor to Uber, okay. So it's spelled LYFT. So these companies are all coming out. So these are all basically decisions that a CFO has to make. So do I sell my shares now? Like if I'm looking at the US stock market, okay, do I sell my shares now? Okay, we are really drifting from our topic, but I hope you guys don't feel lost. Are you feeling lost?
No, sir.
Okay, good. Because with me there's a high risk of feeling lost, because I have a tendency to move from one topic to the other. So I just want to make sure. Okay, so you can see how well the US stock market is doing. Okay, so this is actually drawing. Uber is not profitable. Lyft is not profitable. They have huge losses. Okay, huge losses, like billions of dollars in losses. They're not making money, but they're coming and selling shares. Yes, Parul is very disturbed by that.
I was asking for the US remind me.
You asking for what?
Attendance. You have not taken it.
Oh, I haven't taken attendance. Okay, good, very good. So, I've taken it. See, I forgot. Okay, so you can see how the US stock market is doing. It's doing very well. Okay, so you can see how these companies which are not profitable, Lyft is not profitable. They had like a $1.5 billion loss or something. Then Uber had a $1.5 billion. These guys had 900 million loss. Okay, so even loss-making WeWork is also a money-losing company. Okay, WeWork has a lot of revenues but a money-losing company, and they're all coming to market and trying to sell shares. So even when you're selling shares, try to understand why understanding financial markets is so important, because in pretty much every finance role, even if you're a CFO, you're concerned with raising capital. Okay, once you get the approval from the authorities to sell your shares, you still have a decision to take. When am I going to sell it? Because you have a little bit of time. In India, you can actually sit on it for even 1 year. Okay, so then in 1 year, a lot of movement can happen in the stock market. So if you sell it immediately, okay, then the market goes up. If you take the example of Snap, okay, so this is November. This is when the US election happened. So Snap got their approval for IPO before the US election. Okay, and you remember there was a lot of uncertainty because people, of course, they got both the things wrong. Everybody said that Hillary would win, and then they said if Trump won, most of the economists, the Nobel Prize winning economists said if Trump won, there would be a global recession and the US stock market would crash. okay, and after Trump won, you can see how the stock market has gone up, okay. So they were wrong on both counts. But the point is that, so with so much uncertainty, etc., the Snap CFO, just think about a situation. If he's got his approval, the election is on 9th November. If he's got the approval, okay, let's say in late October, now he's got a chance, he can sell it right now, he can sell the shares right now when the market is over here. Now if he does not sell it right now and he waits till after the election and the market actually crashes for whatever reason, then people are going to say, you're an idiot, you should have sold it earlier, right? But if he sells it right now, if he sells it before the election, and then as you can see the market shot up, then says you're an idiot, you should have waited. So whatever you do, there's a risk, right? So you can understand, even so this trading business that we are talking about, how to manage your risk in financial markets as markets move around. This is a very important skill. Essentially it's focused on how to navigate financial markets, and every time and even this guy has risk on the books, you can see, because he has approval to sell some shares. So if the market goes up a lot more, he'll get much more bang for his buck. If he waits and the market actually goes up, he'll get much more, he'll be able to sell his shares at a much higher price, okay. So that's going to be profit for him. So everywhere there's risk involved and profit involved, okay. So and then you have to essentially, you see that eventually the heart of it is you have to take a view on markets. Can you see that? Even a Snap CFO has to take a view on the market. Can you see that? Essentially, okay, when you're looking at the timing of, you can of course not take a view and just immediately sell it as soon as you get the approval. But most people actually don't do that, okay. So therefore, that's why this entire course curriculum is designed in this way. And one of the things, hopefully, that you guys are learning through your project in this particular course, and you learn in your other courses as well. Are you getting the feeling that you're getting a feel of what it means to take a view on markets?
Yes.
Are you getting that? Okay, so this is why I say this is a very important part of your learning, because this is the heart of it actually. Essentially, you'll have to figure out your own way to navigate through markets and how to manage your risk. Okay, luckily when it comes to risk management, at least you can have much more watertight rules. You can have systems that actually you can always follow. Okay, so that's what actually will protect you. Okay, so we go back to TCS. Let me go back to this. All right. So the reason I came to this, the reason I started getting off track was because I was talking about the importance of psychology. So what I was saying is that you when you move your order, this is called the trailing stop. Okay. So if eventually it goes above this, and then we move the original stop on the long-term system. For the long-term system, we move the original stop to here. Okay. This would be called a trailing stop. Is this clear? This would still make you lose money, but you would, because your entry price is here, but you will lose a little less money than you would have lost earlier. Is this clear? So you can't, I think what extrapolating from what the kind of questions Tanya has asked earlier, so she could ask this question that I think somebody actually did ask me this question earlier. I don't know whether it was her. That why don't I move my stop to, I think it was you. Why don't I move my stop to my entry price so that then I don't lose anything? Okay, are you able to follow the thinking? It's not, she's not crazy for doing it, for thinking in that manner. It's a natural consideration. So what she's saying is that maybe what she'll say now, okay, is that initially I took some risk on this. Okay, I was risking $10,000 on this, but now that I bought it here and it's moved all the way up, okay, fine, even if I feel it's going up, why don't I move my stop to my cost price? Are you able to follow what she's thinking? That I bought it at 2101, so let me just move the stop to 2101, so that later if I lose money, if my stop is eventually triggered, then I have a no NPNL, basically no profit no loss situation. Are you able to follow her thinking? Right? Like I have a break-even stop. Like a lot of the time you'll see in the market people say I have a break-even stop.
So how can you?
Are you able to follow what her thinking is? I'm not saying it's correct, but I'm just trying to show you what is a natural way to think for people, right? So is everyone following so far? Okay. So what I'm saying, so what I would say to that is, yes, Parul, what is your question?
I'm saying, how can it be a break even? Because we have commission also on that shares.
You have what?
Commission.
Yeah, commission, we would include the commission also in the break-even. So if the commission is 1 rupee per share, then she would place it instead of 2101, she would place it at 2102, assuming you have no slippage. So that would be factored in if you are actually following that strategy. Okay, so a lot of times in the market you'll find people talking about I have a break-even stop. Okay, but most of the time that break-even stop is likely to be nonsensical. Okay, because remember the market does not care about your break-even. Okay, so your stops have to be meaningful from the point of view of market action. Okay, so can you see that? Okay, when this breaks, when this thing broke, can you see that the break of this low is a meaningful event from the point of view of the what the market is saying about the trend? Can you see it's a meaningful event because the pattern, by breaking this point, the market destroyed the pattern of higher highs and higher lows. The pattern of higher lows was destroyed. Yes, Yoga is not convinced. What is your confusion? Are you able to follow what I'm saying? I'm trying to distinguish between her suggestion of putting a break-even stop versus what we've been following so far, which is our stops are always at highs and lows. The importance of putting stops at highs and lows is that when that stop goes, you get some meaningful information from the market. That it tells you that a particular trend is destroyed. Are you able to follow? That a trend is being neutralized. But if the market goes through this, it doesn't really tell us anything as such. If this 2101, whatever this level is, okay? At this level, it has no particular significance from the way, from the point of view of the way we are looking at the market as trends and highs and lows, higher highs, higher lows. Are you able to follow what I'm saying? Yes. Here what I'm saying is that the break-even stop, the desire to have a break-even stop is a natural human desire, okay? But understand that it is most of the time wrong, unless you happen to be, you have gone long exactly at the low. In this case, your break-even is also equal to the low. But the point is, it's not, that's just a coincidence. What really matters is the fact that it's a low, not that it's your break-even. Are you clear about what I'm saying? Is everyone following? Yes? Okay. Okay, so that's what I'm trying to say. So again, this brings us back to the point of psychology, trading psychology. That's why I mentioned this book. It's a very important book, okay? And that's why I gave you all the other roles where when we call it trading, actually it's nothing but navigating the market when you have risk, you have a potential for loss and a potential for profit. In every situation, it's the same thing. A CFO of Snap taking a decision to do it right now, the IPO right now versus waiting for the election. It's the same thing. He's navigating the market. He's taking a view on the market, and he's got high stakes involved because there's a potential for profit and loss. In every situation, it's like that. Okay, so it's not the trading is to be seen not in a narrow sense, but in a very broad sense, because that's pretty much what you'll have to do in every finance role you can think of. Okay, so this is a very important book from the point of view of trading psychology, and this subject and trading psychology is very important because it helps to keep you disciplined. When as a human being we are very emotional, so we always want to take big decisions based on emotions, okay, and sometimes we don't realize it. So those kind of decisions are not likely to be correct. And in trade, if you want to trade like a professional trader, as you can see, many of the rules that I've given you for professional trading, these are not things which come to us naturally, right? Like if I say, do you want to eat chocolate? Everybody wants to eat chocolate, right? So you don't have to say, say to people, be disciplined and eat chocolate. That's what people want to do anyway, right? So the point is that discipline is important because most of the correct rules of trading require discipline because they don't come naturally to human beings. Okay, you would have noticed in your own trading that when you have a losing position, you don't want to cut it, right? And you are quickly taking profits on whatever you have a profit, you're taking the profit quickly. You have noticed this? Have you noticed?
Yes, sir.
Right? Yes, Chuk? You have noticed this also? Okay, so when you have a profit, you want to quickly capture it, but when you have a losing position, you're reluctant to cut it off and realize the loss. Is that clear? Okay, so this is a natural human, but this goes against the very principles of trading. It's just the opposites of good trading principles. The good trading principles are you should cut your losses and you should ride your winners. Okay, so therefore that's why I'm saying that discipline is very important, and understanding your psychology is also very important. Okay, and not just in a pure trading environment, in a broad view of navigating the market and taking views on the market when there is a potential for profit and loss on both sides, on either side. So that's why I said this, so that you can read these books. So get into the habit of, and I'll quickly give you the list of other books, okay, and get into the habit of reading classic books. This is very important, okay. Reading classic books should come immediately after your curriculum and the other market following, following the market, all those instructions that I've given you. Okay, so this will be, we had a little bit of an off-topic discussion here. Okay, so this is these two books. Okay, so we go back to pyramiding, what we already said. So the point to understand when you think about when you think about systems, short-term systems, long-term systems, okay, multiple degrees of systems, multiple levels of systems, it's all anchored in the stop. Okay, so that's why we say that your maximum risk per trade essentially is talking about the maximum risk that should be attached to a particular stop, to a unique stop. So every system is defined by the stop. Right now our short-term system was defined by this stop. Okay, once this has broken, now it is really defined by this stop. Okay, but it will wait to see whether there is another low formed over here. When the market starts rising again, then you can pick another higher stop. But right now you can see that this stop is gone, and really the short-term system would be defined, and it's really not there if you are going to maintain the bias of the longer-term system, which is the long bias. Okay, then you really don't have a good stop for the short-term system right now. So the short-term system is what we say out of the market right now. It has been stopped out and it's out of the market. Okay, and the long-term system is still continuing with this stop. So is this clear? So I just want to get you guys into this part of your training in technical trading, which is very important actually. It's a complete system. Technical trading is a complete system, and it will ensure that you always survive, because it's intimately tied to risk management. So if you think of the systems, and you already have the idea of multiple time frames, big picture, short, small picture, and all that. And whenever you think of a system, you think in terms of stops, and stops are given always by highs and lows, and that will connect you to the idea of the trend. So you look for a trend, you take a view on the trend, and then you have the highs and lows, which make it very clear. Well, basically give you clear-cut stops. So it's a very objective system. You don't have to worry too much about how to figure out where to. Like, I'll give you another example. Let's say. So therefore, it's very important to be able to stick to the trading plan. Okay. So let's look at this Facebook on a daily. Okay, so gaps are because this is the earnings gap actually. So this is when you trade stocks. There's also, if you wanted to be really conservative, okay, is that when you come into earnings, you should square your position, or you should buy some kind of option protection, because you can have massive moves in shares after earnings. Okay, you can actually have massive moves even after downgrades of this and that. So earnings here, actually what happened on this particular earnings event is that it's not that their profit numbers were down, it's just that they revised their outlook down. Okay, the forward guidance which people give and companies give, they just revised their forward guidance down a little bit, and then you had this massive drop. So there's no way to tell. This is why it's so difficult to design predictive models in finance and economics, that basically you don't know how the system will react. Okay, so essentially you can have a model with multiple variables. You don't know what variable the market will consider important today. You might have noticed some of this in your own observation of the market, that what the market chooses to focus on seems to keep shifting. They're not consistent. Okay, so you have a major company like Facebook, which actually is making a lot of money. Okay, they're actually minting money in through ads, but just because they gave a little bit of weak guidance, then does it make sense to you that the price should drop like this? If you can see how it dropped, right? So it was like somewhere here, whatever it was, maybe it was 217 or something. Okay, and then it drops to 179. Okay, something like that.
Follow correction.
Yeah, it's a correction. You would call it a correction. But the point is, look at the size of the move. and this is not some mom and pop company. This is like a huge company which is literally minting money from ads. Okay, it's a cash machine. And so this company, just because they give some weak guidance, even though the numbers are okay, the actual reported profit numbers are okay, the market drops like this. So it doesn't seem to make much sense that there should be such a dramatic drop for a company like this. Okay, so but this is how the market is. Okay, so even for a mainline stock like Facebook, and this happens a lot in equity markets. Okay, so that's why one of the rules of, if you wanted to have a really conservative equity trading program, you would as we come up to an earnings date, you would square the position or you would buy some options protection. Okay, so in this case, if you were long, you would buy some out of the money put protection, so that if the market drops, and then you buy short dated puts. Okay, and then as soon as the earnings event is over, then you would again square that position, or the put itself would expire. Okay, so this is what. So what I'm saying is that so it's very simple. You can see the system is very simple. At this point, if somebody here were going short, so you can select highs and lows in technical trading as stops. If you see somebody at this point, let's say, and not here, but somebody at this point, if they were going short Facebook, where would the stop be? If somebody was going short Facebook, if you see that there's this long uptrend, this is the IPO period. From the IPO, earlier there was a concern about Facebook will not be able to monetize mobile advertising. Okay, but as you know from being frequent users, they are doing a pretty good job of it. So then it started rising. So you see that there's a very long uptrend. There are some small breaks in the trend here. Okay, this is like a different degree of trend starts. Okay, but you can see there's a big break here on this. Okay, so somebody might take a view at this point of time that the big uptrend in Facebook is over. Now this thing is going down. It's going to go down to $100 or something. So if you go short here, where would your stop be? Here, right? Everyone is convinced? I'm going short. If I'm going short here, I said my view is that the Facebook big uptrend is over. Okay, and this is going down to $100. Okay, and let's say I'm lucky enough to get this price level and I want to go short here. Then my stop, as Tanya is pointing out, should be here. Is everyone able to see the logic of that?
But sir, if your view is that you go down, why will you put your stop above? You know it will go down, so you should sell it at that point only.
No. I'm going short here, let's say. Let's say the market is at this point, and I'm going short here. When I'm going short here, I have to put a stop somewhere.
If you're going short, you will sell at the market price right away because you're going short.
No. I'm going short means I will sell at the market, but after selling, I have to put a stop, right, to protect my losses.
After selling, why did you protect your losses? You're out of position.
What? No, I'm going short. I don't have a position. I'm short selling. I'm engaging in short selling. Okay, so this is another thing that you guys should read up on. Go to the Interactive Brokers website. There is a good, I'm sure, just search for a short selling tutorial. There is a nice tutorial with pictures and everything of how short selling works. You borrow shares. So I'm talking about short selling. Okay, so you're still in that mode where you have to buy and but as finance students now, and especially since we are studying finance from a global perspective across asset classes. Okay, we are not studying just stock market, right? Sometimes people go, I want to know what stock market. It's not like that. Everywhere in India people talk like that, stock market. Okay, but it's not like that. You have to think about global markets, okay, across all asset classes, across all instruments. That's how you learn finance. So to the extent that there's commonality across all these elements, you should learn it as general principles. Are you able to follow what I'm saying? Okay, so therefore you have to get into that mode. That in finance, whatever you want to sell, you borrow and sell. Whatever you buy and put it on investment. Okay, if you are buying currency, you just put it as a deposit. If you're buying gold, you try to lease out the gold. There is a market for leasing gold actually. Okay, so you get some kind of return. Okay, so is this clear to everybody? Whatever you buy, you put on deposit. Whatever you want to sell, you borrow and sell. That focuses you squarely on the carry of the trade, of the net return on the trade. If you're borrowing something at 13% and you're getting a return, whatever you bought, well, if you're borrowing at 13% and buying some asset, and that asset is only giving you 11%, then you're losing every day, right? Because your carry is negative. This we say your carry is negative, okay? But then you can still make money if the asset shoots up like a rocket. Like the shares of Roku. I was just looking at the chart today. The shares of Roku are shooting up like a rocket. Okay. So if the asset, are you able to follow this logic? That even if your cost of funds is 13% and the return on the asset is 11%, okay, that is the interest return on the asset is 11%. So you're losing money on the interest part, okay, on the interest carry. But if the asset price, that asset that you bought, if that price shoots up like a rocket, you can still make money. Are you following what I'm saying? Okay, so that's the whole game basically. So you borrow whatever, so you get into this habit of thinking in terms of global markets, across asset classes, across instruments. Always think on both sides. You're free to go short or long in general in liquid markets. Okay, in certain markets, like as you can see in India, you would face institutional restraints because the market is not developed. But the point is here. So what I wanted to emphasize here is that in technical trading, it's very simple and it's quite objective. As you can see, if I'm going short here, so this is clear now, I don't have a position, I'm short selling here, okay, but then where would I put my stop? It would be here, right? Because, why? Because if I'm going short and my view is, what is my view? That the big uptrend in Facebook since its IPO, huge uptrend really, okay? So this whole story is over. Now Facebook has a lot of problems, okay? So this stock is going down to 100 and I'm going to sell it here. But then I should put a stop at 225 because the moment it goes above this, whatever this high is, okay, that means it's proved my view is wrong because I said the big uptrend is over. If it goes and makes a new high, then the whole big uptrend has started again. So if my view is correct, then it can't go and make a new high. So I just picked the latest high that I've seen, the highest high that I've seen, and I put my stop there so that when I go short here, this is my stop, so I'll lose this much money. Otherwise, it may, if my view is correct, actually, it may go to 100. This is clear? Okay, so that's what we are saying, that technical trading is very simple. Okay, so we were talking about pyramiding, and the very important thing I think to understand is that, so when I'm looking at this big picture, I was talking about systems and stops. You know, you have a big picture system, a small picture system. So you think of every system in terms of a stop, and the stop is connected to the view. And the view is basically just that you either take a view that the trend is going to continue, or that the trend is going to go is over and it's going to turn around. Okay, so in a way what I'm saying here, that this big trend, okay, is, of course I already have some confirmation because this major low from which the latest high was made, this low was cracked. So I do have some evidence in the market that there is a problem with this uptrend, okay, because this long uptrend has actually been neutralized and it has not re-established itself by making a new high. So I do have a fairly strong case for going short. Okay, the really adventurous part would be that if this part had not happened, as the market is soaring like this right at the high, then you try to go short. That is really adventurous because you're really going against the trend. But you can always do that, but provided you have a way to control your losses, that you have a objective and a systematic method of putting stops so that you don't lose too much money on a trade. You can still do that. Okay, so the point I'm trying to emphasize here is that technical trading is quite objective and it's quite simple, and all you have to do basically is look at the chart and take a view. Only two things are possible: either the trend is continuing higher, or it has ended and is now going to turn around. This is clear? And turn around because we know that there is cyclicality in markets, right? We know that. You understand what cyclicality is? The property of moving in cycles. Hopefully we'll have some chart here. Okay, so that's all we are saying. So what I'm trying to emphasize here is kind of doing a wrap up on technical analysis, okay, a technical trading strategy. You see how simple it is. All you have to do is basically take a view on the trend. Okay, either the trend is, and it's quite simple, it's not that like too many possibilities exist. Either the trend is going to continue higher or it's going to go down, okay, or it's going to turn around, okay, so, and go down in this case. So that's basically all there is to it. And cyclicality I wanted to show you. So this is what I mean by cyclicality. Yeah, you see that? So US Treasury, this is the yield on the, can you see the percentage there? Can you see the percentages? Rajan, can you see at the back? This is 17 and a half. So this is actually, so this is the US, so this is the 10-year interest rate. Just like in India, we monitor the 10-year government bond. Okay, so this is the 10-year. This in the US, it's called a note. At the 10-year maturity, from 2 years, 5 years to 10 years, it's called a note. It's called a treasury note. At 30 years, it's called a 20-year, 30-year. Those are called treasury bonds. But those are all part of what we call the bond market. Okay, later on when we study capital markets, you'll see. So this cyclicality. Can you see what I mean by cyclicality? That it's moving in a cyclical fashion. Not very neat. But at least if you look at up to here or so, it is kind of almost symmetrical and balanced. And actually this goes back even further. There's only 62. But if you go back to 45 or so, you'll still see this beautiful cyclical movement. Goes all the way up and then comes down, almost equal time frames. Okay. Right now it's a little bit overbalanced because it's been going down for much longer. Okay. So, but this actually, this database can go back to, some other database can go back to about 45 or so. Okay. So are you able to see what I mean by cyclicality? And so everywhere you look, can you see what I told you, that wherever you look, this is the interest rate that the US Treasury has had to pay over the years to borrow for 10 years. So when the US Treasury is issuing 10-year debt securities, it has had to pay these varying rates of interest. Okay, so it's not some chart that I drew manually to make it look like a cycle. Okay, so you can see how naturally things are moving in a cyclical fashion. Okay, so this is an interest rate. This is a very important interest rate. So this is the market that you should always follow, the most important interest rate market in the world in terms of long-term interest rates, 10-year US Treasuries. Okay, so this is where we are. Okay, so we will continue with, we have some time. So we'll continue with the decision problems. Okay, so we have already gone through most of the decision problems. Now we were trying to look at, we'll just try to cover these order types in greater detail. Okay, so we have these order types that we are going to look at. Now we're just going to cover these order types in greater detail. So I've given you the link to the IB definition of the market order. The IB definitions are very good. Okay, if you see any conflict, we have given a little even more tightly defined definitions here. Okay, but IB definitions are very good. And if you actually look at IB somewhere here, so in trading, you'll find. They put it under trading order types, or just search for order types. Okay, you'll get they have a big section on order types, and we are only covering a few types of orders, but you can read about many other types of orders that exist on the IB website. Okay, this is a very good website. So this is where you go and search for short selling, and you'll get a tutorial as well. Okay, so market order, now just to understand, when we are going to talk about, we're going to be talking about parameters, number of parameters in an order. Okay, and when we do that, we are not going to talk about these. When we say number of parameters, we are leaving out these three things: time in force, amount, and destination. Okay, so if you can see here the destination is NSE. Okay, this destination is important because this system is quite sophisticated. You have this smart routing system. Okay, so you can also have smart destination. So in the US, for instance, there are many destinations like NSE, BSE. There are many destinations. So you can choose to send your order to a particular destination. Okay, you can instruct the system that I want my order to be only on the NYSE, or I want my order to be only on the NASDAQ. Okay, I want it only on the Instinet platform. Okay, you can instruct the system. So that's why this is also a parameter of an order. Okay, parameter, you understand what is parameter? It is one of the elements that you have to specify in order to, like if you say I want to buy a car, then the brand is a parameter, whether it's a diesel powered or petrol powered, that's a parameter. All these things you have to specify in order to flesh out the concept. Okay, so we normally, when we talk about the number of parameters in an order, we are not going to talk about this. What is this? Time in force. Okay, so this is time in force. Time in force, this time in force parameter is there for every order. Position size, we are not going to talk about this, also a part of the parameter of the order. Okay, so position size, time in force, and destination, these three things we are not going to talk about because these are there for every order. Okay, so when we say number of parameters, for when you come out with an answer, we say market order has no parameter. Actually, you can add when we say 0 here for market order, but actually these 3 parameters are always there, even for a market order. Okay, so although time and force is not really there because the market order is just, but for most other orders, these 3 parameters are there. We don't talk about them. So market order, understand basically what is the logic of a market order. We have this definition here, but we can, I've actually copied this definition here. We don't worry about this part, okay? So I'll just put this, this is already there in your, I'll just put this in your notes. So we are covering this, that we are, so we already have a good idea about market orders. Okay, so I'm not going to spend too much time on this. Okay. So what we say is that in the market order there are no parameters. Okay, it has 0 parameters. Okay. And what we are saying is there is a guarantee of execution, but there is no guarantee of price at which execution occurs. Okay, you can see this. This is already there in the IB website, and I've now put it into this also. But basically, just try to understand what a market order is. A market order basically is an instruction to the system that I want to sell or buy. It can be a sell or a buy order. Okay, so I want you to sell or buy immediately. I don't care what the price is. Just buy it. Okay, so you are familiar with this kind of a situation. So this you normally use when you have a fear that the market is going to run away from you, right? That if you don't buy, if you're trying to buy, if you don't buy it immediately, the market is going to shoot up and eventually you'll have to buy at a much higher price. So generally when you have a view, so every order type is connected to a view. You can understand clearly that in the case of a market order, the view is that you're afraid that the market is going to run away from you, against you. Okay, so therefore you want to buy it or sell it immediately. Okay, so that's all it is. So market order is just an instruction to a system, okay, that you have to sell it or buy it immediately. I don't care what the price is. And that's why there's no price guarantee. So that's why we say that there is a guarantee of execution, but there is no guarantee of price at which the execution occurs. Okay, so that's why we see when you sometimes place market orders, the system will give you a warning sign. Okay, that's why they want you to understand, because this is a big deal from a regulatory point of view. The regulators want to know that you are warning your customers about, you're making sure that your customers know what the risks of different types of orders are, so that you're not deceiving your customers. So that's why you'll see the brokers always giving you a warning. Okay, so this is all there is. Okay, so if you can straight away, this leads us to the next type of order, which is the limit order. Okay, which is, okay, let's copy this. We can copy a stop order also, but these DPs are actually a little bit, we don't want to use the DP numbers because the numbers have become mixed up. Okay, so all these DPs have to be removed. We'll worry about the DPs later. Okay, so we have limit orders, and then we have to remove all the DPs. This communication has become, yeah. Okay, so what we have, the next one is, so what is the system telling you? That market order, there is no guarantee of price. If you want a guarantee, what are they telling you to do? What should you use? Limit order. Okay, the system is already telling you that if you want a guarantee on your price, you should use a limit order. Okay, so you can see here limit order. You've already seen how limit orders are entered. So essentially a limit order, what we are doing, why do we enter a limit order? If now again in the case of Facebook, let's say, if I feel that I want to sell it, if I still feel bearish that I want to sell it, but maybe I take a view on this is why it becomes important to look at multiple time frames. Okay, so I'm not just going to look at this larger time frame here. Okay, I will look at also, this is a very big picture time frame on the daily chart, but I will also look at, I'll take a view on looking at the 15-minute chart also. So I see this peak over here, and I feel maybe I look at a market here, I want to go short, but I feel by looking at the 15-minute charts, I have a view that this thing is going to go to 200 before it drops. Okay, so you have to take a view on the short-term pattern as well. Okay, so then what I do is, instead of selling at market, because I'm fairly confident that it will go here, so therefore what I do is I place a limit order to sell at 200. Is this clear? So this, you can see the difference in the view. So here I'm a seller, okay, I'm looking to sell, but I'm not worried right now that the market is going to crash right away and I'll lose my price. In fact, I feel that the market is likely to come to around 200 and then drop. So you can see that you have to form a view not just on the big picture, but also on the small picture. So every degree of trend that you look at, you have to form a view. Okay? And then again, as you can see, the view will always be based, anchored in the stop, because the view is essentially a statement about whether the trend, the current trend that you can see, whether it's over or not. So therefore it will be anchored completely in the stop. Okay, so like now this view, for instance, if I take this short-term view, okay, that okay, so if I take the short-term view that this is, I want to sell, but I think this is going to go to 200 before it drops. Okay, so again you can see how the stops are important. So the first warning that my view is wrong is that if it straight away drops below this level, and then if it drops below this level, then I'm clearly wrong in my short-term view. Are you able to follow what I'm saying? So if I'm a seller and I'm thinking that I'm going to get a chance of going short at 200, but the moment the short-term price action is such that it starts dropping below this and goes below this also, then I pretty much have to revise my view because it's not working. The short-term view, obviously there's some problem, because I thought it would go to 200 straight away and then drop, but that's not working out. So you can see how another advantage of technical analysis is that it allows you to take very specific views, very precise views, and it gives you an opportunity, because you're just dealing with markets and objective data. So you can see here later on when we discuss models in fundamental analysis, I'll talk about this aspect of assumptions. Like I talk about models as just a bunch of assumptions. Okay, so there's nothing wrong with that, but then what we really want to know is my assumption still valid? So if my assumptions are breaking down, I want to know quickly. So in very brief terms, what I will tell you, one of the reasons why I think technical analysis is a superior system is because in technical analysis, you get very quick information when your assumptions break down. Are you able to follow what I'm saying? Here, what is my assumption? I'm taking a short-term view. My assumption in the short-term system is that the market will go up to 200 and then fall. Ideally, won't even go below this. Certainly not below this. But then the market drops below this and it drops below this, and immediately I know that whatever I was assuming is wrong. So whatever decisions, whatever plan I had based on my assumption, those are all gone for a toss now. But in fundamental analysis, so the point is that every model is going to, this is also a model essentially. This is also based on a model of price action, okay? That this pattern of high lows is not over, okay? That is actually the superimposition of a model on the price action, okay? So then what I'm saying is that there's nothing wrong with a model being a bunch of assumptions, and every model is a bunch of assumptions. What is really important, and this is something you should appreciate because you will not hear it in any textbook, you will not see it in any textbook, but understand this, that every model is going to be a bunch of assumptions. There's nothing wrong with that, okay? But it is very important because you're dealing with predictive models and you're dealing with losses and profits if your assumptions go wrong. Okay, what is very important is that you get quick information on the breakdown of your assumptions so that you can quickly take action to reverse your whatever you did. Are you following what I'm saying? So one of the reasons I prefer technical analysis from a model perspective, this is also a model. I impose my model of price action on this and I say this is not over, it's going to 200 and then coming down, okay? But my assumptions are obviously that therefore it can't go below this and certainly not below this, okay? Before it has to hit 200 and before that it should hit 200. The moment the market actually goes below this and this, immediately my assumptions have been broken and I have that information with me, right? So I know that my model has not worked and therefore I can take quick action. So this is one of the reasons I think that technical analysis is superior, because you get very quick information on the breakdown of your assumptions. It's a very precise method. It's very logical. Can you see that it's all logical, what we are doing, right? You may disagree with my taking a negative bearish view on Facebook. That you can always do. But the point is, from starting, once you accept that bearish view, everything else is logical. Can you see that? Once you decide not to question why I took a bearish view, why I didn't take a bullish view, okay, that's a separate matter. That will never be resolved. It's always subjective. Okay, so your time is up now, so I'll let you go. But I hope you understood. This is a very important point, that when you understand that even technical analysis, what we are doing by projecting all these movements, we are just applying models. But the advantage is that because it's based on highs and lows, which are clearly observable, when the assumptions break down, you can see it immediately, and you can immediately take action to reverse your decisions. Clear? Okay. Any technical questions? Then I won't close the recording. Anybody has any technical? You can go now. So our next class is on 27th.
I sent on for fees issue and
Fees. Yeah, don't worry, that will correct, because I have the emails from Shoma. So you have the same thing. So we'll correct it eventually, because your decision about this is only going to affect your
Same
decision.
problem occurred with Sanjay Chaudhary, so he haven't got the mail, but
No, I've got the mail. I got the mail. I just haven't looked at it. I mean, I've looked at it also, but I haven't incorporated it in the. But we can always do it later. Okay. Okay, everybody, we can shut. Okay.